In today's video, I want to touch on three amazing businesses that you might or might not have heard of before. These businesses have been performing extremely well in the last couple of days, stock-wise and business-wise as well. It might not be the sexiest business out there, right? The Nvidias or the Palantirs or the whatnot, but these are exceptionally good businesses, great models, and well, the stock did reflect that performance. So yeah, some of them are quite pricey today, but I still believe that these are amazing businesses to own for the future. Now, right now, what I'm showing you here is again the same thing that I've shown you a couple of weeks ago. Year-to-date performance of the Nasdaq, Dow Jones, and S&P 500 compared to Germany, France, and China. And what you can see is that, well, they're trailing. The American markets are trailing the Chinese, German, and French markets' performance right now. You might think this is insane, but don't forget that the US already had two extremely strong years, 23-24. Germany, France, and China, not so much. And so that's why I start to talk a little bit more about European stocks, Chinese stocks towards the end of 2024. So far, I guess it is working out. Have you been buying any European or Chinese stocks? Let me know down in the comment section below. The three companies I want to touch on in this video are Waste Management, Intuitive Surgical, and Atlassian. If you're not interested in hearing more about that, let me know down in the comment section, like, and then you can turn this video off. And also do me a favor and subscribe so we can reach that 100,000 mark faster than expected. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So I want to start off with Waste Management. Waste Management has a market cap of $90.4 billion and a forward PE of 29.4 times. As you've seen here, this is not the fastest growing company out there, but yeah, this is one of those boring companies, but boring, growing quite nicely, pays a dividend, buys back share, free cash flow positive. So yeah, one man's trash is another man's treasure or something like that. I think that's exactly what you're getting right here. The current average analyst price target sits just 4.3% higher than the price we're at today. And then looking at some pricing metrics with the recent recovery in the stock, we can see that forward PE, EV to EBITDA, price to sales, price to free cash flow are all a bit higher than the 5-year mean. That's why I'm saying, yes, these companies are a bit pricey. So if you can buy them on the dip, that would be much better. If you're a golf fan, you probably know this course, a wonderful, wonderful course sponsored by Waste Management. Now, if we zoom out a little bit and we see what has happened throughout the last couple of years, we can see that free cash flow has grown at a CAGR of 10% and is actually expected to grow a bit faster than that in the coming fiscal years. If we look at how they generate their revenue, well, the majority comes from, well, collection, basically. Collection revenue is the majority, then landfill revenue, and then transfer revenue. We also had a couple of new segments come in here in 2022. That's recycling, processing, and sales revenue. Waste Management renewable energy revenue, and the newest one addition here is Waste Management healthcare solution revenue. Yes, I was also surprised to see that, but the majority does come from just collection and landfill revenue. All in all, what has happened in the last couple of years, gross profit margin stayed around the same 36-37%. Free cash flow margin was usually closer to 12-13% or so. We've seen in the last couple of years it dipped down. CapEx did increase, but we are making our way back up, and that's probably why the stock has recovered as well, because you can see that we've seen since 2021 revenue has increased faster than before, and so you would like to see free cash flow to go back up. If we can go back up towards the 13.5% or so, then I do believe that this growth here could be achievable for the future. That's why we're seeing that free cash flow is expected to grow a bit faster than before as they generate more revenue and as the free cash flow margin goes up again. Moving on to company number 2, and that's Intuitive Surgical. I know some of you own this company because I've seen this name in the comment section quite a lot. So this has a market cap of $211 billion and a forward PE of 73.5 times. Again, not a cheap name out there. The performance in the last 3 years has been exceptional. Then looking at the growth rates, sales growth of around 15% year over year for the coming fiscal years. EPS in fiscal 25 is expected to be just below 10%, but then you can see that it's again going to be on average 15% year over year growth. The average analyst price target sits 6.6% higher than the price we're at today. And here as well, the pricing metrics are higher than the 5-year mean, but you can see here price to free cash flow, that's in the last 12 months. As this company generates more and more free cash flow, that metric is coming down quite rapidly. Definitely not the cheapest stock out there, but one that if you see a major correction, a dip, I think this is a buy the dip opportunity. Well, for those that don't know what they do, they basically specialize in developing, manufacturing and marketing robotic surgical systems, such as the Da Vinci surgical system, which you can see right here. Now, what has happened in the last couple of years? Well, since 2015, you can see that revenue has grown at a compound annual growth rate of 15%. Free cash flow for a while was growing a little bit, but not by much, but it is expected to grow quite rapidly in the coming fiscal years. As for the Da Vinci system, we can see that the install base is closing in on that 10,000 mark, and that since 2012 has grown at a compound annual growth rate of 11.8%. To be honest, when you look at this machine, this really comes out of a science fiction movie, and I would not want to be under it right now. If I am, hopefully I'm sleeping. Overall, how do they generate revenue? Well, there's revenue coming from product revenue, which is the majority. That's that darkish blue bar here. And then the rest is service revenue. Both of them growing actually well since 2012 at a compound annual growth rate of 11.8%. During that same period, revenue from the United States grew at 10.3% on a compound annual growth rate, and OUS grew faster than that, 16.3%. All in all, we are seeing here a bit of the same trend as with waste management. Gross profit margin about the same in the last 10 years or so, but with free cash flow did take a dip here as well. CapEx did increase in the last couple of years. So we went from around 26 to 30% free cash flow margin all the way down to 15, 10.5%. And then in 2024, we've seen a rebound, 15.6%. I expect this to make its way back up above the 20%, which is also why we're seeing that big increase or the expected increase in free cash flow in the coming years. And again, this is one of those businesses where you might have heard about it, never really dived right into this because it might not be interesting, but as the stock's performance has proved and as the business is proving right now, these are wonderful businesses to own. Might not get the same headlines as all the rest, but at the end of the day, you want to own good businesses and of course businesses that you understand and that generate quite a lot of revenue and profits. Moving on to the last one, and that's Atlassian Corporation, ticker symbol TEAM. This one has a market cap of $83.5 billion, and here as well the forward PE is quite high at 83.3 times. But there is a reason for that. It's still expected to grow quite rapidly, top and bottom lines. Now, this name has actually been on my screener for a long time. I might say, okay, cool, but look at the performance in the last 3 years. It's still down. And that is true. That is very true. But if we go and look at, let's say, the 6-month performance, well, it's up 125%. I'm going to show you why. Right now, the average analyst price target sits just under 9% higher than the price we're at today. And here, if we look at some pricing metrics, contrary to the other two, well, it still is below the 5-year mean on all of those metrics. Price to earnings, EV to EBITDA, price to sales, and price to free cash flow. And so if we zoom out a little bit and also look at the future, first of all, revenue has increased by 30% on a compound annual growth rate since 2015, so incredible growth. Free cash flow faster than that, 33.5%, and is still expected to grow quite rapidly in the coming fiscal years. Now, if you're using Jira or Confluence, well, it's basically this company. If you follow F1, you now know that they sponsor Williams, which is now the team of Carlos Sainz. And so zooming out a little bit here as well, we can see gross profit margin has stayed about the same, above 80% in the last 10 years. Here we can see exactly why this has started to rebound, right? Free cash flow margin previously, that was always closer to 30%. Then we see that dip, it dipped down to 26.8, 23.8%, stock got hit, but then a nice little recovery back above that 30% free cash flow margin. Revenue continues to grow, and so, well, the stock market reacts accordingly. How do they generate revenue? Well, first of all, we look at the segment that does not exist anymore, and that's the server revenue that existed previously, is now completely gone. Another part, very small part here, is marketplace and services. A very small part here, grew at a compound annual growth rate of 19.6% since the September quarter of 2020. But then we move towards the biggest chunk here, or the bigger chunks of the revenue, and that's data center revenue that has grown at a compound annual growth rate of 49% since the September quarter of 2020. And then we've got the cloud revenue, that's the majority of the revenue right now, that has grown at a compound annual growth rate of 39.2%. And I mean, you can clearly see that this is a business that continues to grow, and as it grows, it becomes more and more profitable. With regards to the number of customers, it's still at around 300,000 here, and the number of customers with over 10,000 cloud ARR is also increasing. So yeah, it was struggling previously, but if you look at the business metrics right now, it seems like they're firing on all cylinders. And so that's about it for me in this video. Do you own one of those 3 companies? Do you have any other boring businesses that you want me to cover? Let me know down in the comment section below. Like, subscribe, do all of that, and I'll see you all in the next one. Bye bye.